Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community. I'm Nathan Stovall, and on this episode, we're once again highlighting some of the best performers in the banking industry and another installment of Tales from Top Performers. You're going to hear from two executives from two different institutions who have employed different strategies, but both have outperformed peers. We're going to dig into what makes their sauce special. Every year, S&P Global Market Intelligence ranks banks, public and private, large and small, based on 8 key performance measures. We take into consideration the operating environment and what challenges exist to really measure who stands out amongst their peers. This year, we put our heaviest weighting on return on average assets before tax and extra, rewarding those who simply have the strongest return and strongest earnings, giving that a 25% weighting. We gave 10% weightings to 3 income statement metrics, beginning with net interest margin, one of the key profitability metrics of any bank. We also gave a 10% weighting to banks' efficiency ratio, wanting to reward those with the most efficient operations. We also gave 10% weighting to the 3-year average change in operating revenue because we wanted to reward stability. Along the same lines, we gave a 10% weighting to the 8-quarter average change in deposits, again, rewarding stability and funding during the fastest pace of rate hikes that we've seen in the last 40 years. And then we had 3 other key stability metrics: 10% weighting for net charge-offs to average loans, 10% weighting for non-performing assets and loans 90 days or more past due to total assets, and a 15% weighting to adjusted tangible common equity to tangible assets. As we've done in the past, we rank banks in different groups: public banks, community banks with $3 to $10 billion in assets, community banks with less than $3 billion in assets. We also rank community banks by regions, digging into who are the top performers in different markets. We interviewed 2 of the winners during a recent webinar: Phil Moore, CFO at Nicolet Bankshares, who came in the 24th place ranking in the large community bank rankings, and Ken Martinek, CEO of Northeast Community Bank, which finished in 2nd place in the small community bank group and 1st in the Northeast region. The 2 executives discussed what makes each of their community banks different, the strategies they employed, and the opportunities and challenges they see over the next 12 months. We started off the discussion with Phil. Here it is.
What we really want to do is talk a little bit about what makes story special at Nicolet, and then we're going to get into the same type of conversation with Ken at Northeast. But Phil, really starting off, what do you think is the biggest differentiator that you have as a community bank? And I think one of the interesting things here is that you were de novo, and it has been called almost 25 years since then. But talk about how you've built the franchise from founding into what it is today.
Good. Thanks, Nathan, and appreciate you including Nicolet in your rankings and in your survey. One thing about Nicolet that we know is that we don't hold any patents or any proprietary technology. Our playbook is generally well known. So if you don't have anything unique or unusual about that, what you realize is that you have to do common things uncommonly well. And so that's something that we really focus on. And we do that by what we call shared success model. And in our shared success model, we think of our 3 key constituents, which are our customers, our employees and communities, and our shareholders. And so shared success is whenever all 3 of those groups win. And so we make our judgments largely based on the idea of shared success and how it benefits all of our key constituents with that. So that's a mindset, right? That's something that we do. So it's not unique and unusual, nothing that makes us different other than the fact that we do that quite well. And so that's a cultural issue, right? Everybody talks about their culture, but we live it. We really focus in on that top down. and we go through that idea and we understand and accept those outcomes, which sometimes are good and sometimes not so good. So our idea is, how do we get better with those outcomes and keeping it to the point of having shared success? One of the ways we see that is the last couple of years, all of our revenue lines have been on a growth mode. So everything in the bank has gone well. We have 7 quarters since our balance sheet repositioning in March of 23 that we went through that have been above expectations, both ours as well as the street's expectations. And so we think that that's what's important, because that means we're mattering to our more than 100,000 customers and 950 employees that we have in our core markets throughout the upper Midwest. So that's really it. I'm sorry I don't have a great sexy answer for you, but it's really doing things the way we think of them in Northeast Wisconsin, in the Upper Peninsula, and UP up in Michigan and over in Minnesota. So that's just doing things the right way.
I want to pick up on one of the things you said there. You mentioned the restructuring. The others have done it, but you guys were a little bit earlier than some. And the pitch has always been, when you could do something like that, allows you to kind of play offense. Do you think that that's key to being able to kind of not sit on the past and go forward and do what you're focused to do, and that 7 quarters of outperformance?
Yeah. So Nathan, we were ahead of it, as in 2 days ahead of the failure of Silicon Valley Bank when we did our balance sheet repositioning. So we were ready to play offense. We had our press release written. We had everything ready to go. And then whenever we had the quake that was felt within the banking space, we pulled back on that and sort of sat quietly until our earnings release in April of 23, when we announced what we had done, simply because we didn't want to shake the market any more than it was. So our timing was exceptional, brilliant, and all the other. And then the other thing was, I think I didn't get a lot of sleep for a lot of those nights, because you just didn't know that was there. And so we joked about that within our executive team, about how smart and brilliant we were and how dumb we were, all at the same time. That said, it did allow us to play offense. We were able, by that, our CEO, Mike Daniels, talks about swimming with a lead vest, because we had $500 million of below 1% earning assets at that point in time with the U.S. Treasuries that we put on. Fortunately, they had a 3-year duration originally that we laddered in, and so it wasn't terribly painful. We could afford it. So it sort of cost us 1 quarter's worth of earnings. But we did it because at Nicolet, we don't play for the quarter, we play for the long term. And so our efforts were all focused on what was best for the shareholders. As owners of the bank ourselves, as we look at that, it was what's best for all of us. Again, the 3 circles. And so that was it was a really good decision that we made, with challenging timing, that, gosh, we couldn't be happier about doing that today, and feeling like, again, we absolutely did the right thing and have profited from it based on the performance since then.
Certainly. Well, I mean, talking about change and taking it in stride, one of the things that's been a key part of your strategy is M&A, to supplement it with organic growth. And, any deal brings change. And you've managed to close a deal almost every year, I think maybe every year from 16 to 22. How have you managed to do that? And one, deliver on the synergies you set out of every deal, but also to keep that culture intact that you talked about earlier?
Yeah. So we start out with the belief that that banks are not bought, but rather they're sold. And so the idea that we can go make a deal is not, we have a lot of deals we can make. Unfortunately, it takes 2 to tango, right? It takes a dance partner in that light. So we created, or our mindset is about creating in the seller an understanding that they are investing in Nicolet, versus being focused on getting a country club price that they can go be all excited and proud to tell their guys they get, because unless you're doing a cash deal, you're really investing in our bank with us and being our partner going forward. And so we use that that mindset, or try to help create that mindset in our partners that we look for. Fortunately, we have a track record and a chart, right? Any financial guy should have a good chart about that. But that shows the success and returns that others have achieved by putting their trust in us and the faith that they have for us to be able to execute and deliver on being a top performer, because that's the approach that we have with that. And again, how have we done that? Through consistency. Well, we have a litmus test that says it's pretty simple. Any acquisition we do has to make Nicolet a better bank after the acquisition. And if we can't answer that question favorably, that this will make us better, then that's pretty easy. The metrics don't allure us just because they're nice metrics if it's not going to make us a better bank overall through that process. So we're brought deals oftentimes through our friends that we have out in the marketplace that we could pay a certain price for, and we would be able to pay that price. But again, our discipline says just because we be able to pay that price doesn't mean we should pay that price, right? It's money that we've made, and it's value that we've created in our shares. And so if they're in our shares, that belongs to our shareholders, and we're willing to share that as long as we can see that we're going to get a good return through that process. But just because we can afford to pay somebody a price because of our premium valued stock that we have doesn't mean that we should. Probably too, one other thing just to throw, because of the way that you asked that question, we have a model of close and convert on the same day. So every one of the transactions that we have done that you were talking about, the one a year through 16 and 22, and we did two of those in 21, $2.5 billion deals in 21. Every one of those deals close and convert Friday and Monday. The bank opens up as Nicolet Bank with our systems, with our signage, with our processes. And so that allows us to immediately recognize a lot of the synergies and the cost saves. But it also gets us all on the same page from the beginning. So it's really clear what ours looks like at that point in time, because we vetted that through our prep process to get us to closing at that point.
And to do that, you almost have to have M&A as a business line, and sort of, you clearly just laid out that approach, right? I mean, you have the plan that you're going to execute on that closing day and make sure everybody's happy to be a Nicolet employee, customer, et cetera, come Monday morning, right? Part of that planning process.
Yep, absolutely. We've always talked about the M&A business line, right? We have commercial, we have retail, we have wealth, we have M&A, right? That has been another business line. That business line has been quiet for a couple of years. Probably you'd say we have a little bit of an itch that we'll talk about, I'm sure, in a few moments. But that said, it's something that we believe that we are good at, and that our track record suggests that, by the way, which creates a lot of capital for us. And that capital is both confidence capital that we have internally, but also with our regulators, where they believe in us too, and in our ability to be able to pull off what we said we were going to pull off at that point.
And deals have brought business lines as well. And, one that I was just going to ask about specifically was the County Bank Corp purchase in 21, where you got into dairy lending. Can you just talk a little bit about that? I mean, you outlined how you guys have done deals and what's worked there, but the idea of taking on something that you really haven't, it's a much bigger, different kind of business. How do you get comfort like that, retain the expertise of the target? I mean, I think that's a key thing if you're going to do something like that.
Right. Well, sort of, in and of itself, I mean, the reason we weren't bigger in the ag business was because County was so good at it, right? So that's the beginning point, which is we knew them as a competitor within our footprint, and we weren't able to shake them. They were really and are really good at what they do. So let's start out with all the deals that we have done. We do our own due diligence. We don't outsource that. We don't rely. I mean, we do the work ourselves, and so therefore our team understands and knows that these will be our credit issues, not theirs. There will be our loan rates, our loan structures that are there, our deposit pricing, and our investment portfolio, if any of those things are different than Nicolet's. So it's not the 6 months later talking about, well, that thing over there. No, that's my thing over there that I own if I'm the credit guy or the investment guy or the retail and then the pricing, right? That's now ours. It's part of Nicolet. And so therefore that really helps setting the expectations that we're going to get a proper understanding of sort of what's under the hood, what it is that we're buying, and knowing that those issues that we're going to face post-integration are us and our issues, not something that we can talk about their piece of it that's there. Specific to County and their dairy lending, again, we knew their bank quite well. As a competitor, they were very successful. I mean, that's a reason why they were. And Nicolet today continues to be the largest dairy lender in Wisconsin, because that team has shown it's very good at what it does. I mean, that's just something that's really there. And if you take those skills that they had, coupled with coming off a real life stress test, because milk had been at its lowest price the few years before we did the deal, we sort of had a comfort that said, while that bank wasn't properly structured because it didn't have the retail presence, it was a really good ag-based bank, but wasn't good at the commercial lending and the deposit gathering. But if we could take that niche and bring it into ours with our understanding and then our ability to lever that further, that was just an absolute win for us. So we thought that, we got in and did the due diligence, we saw that, and through all of that and the fact of limited losses that they had experienced through the years in the dairy space, and knowing that dairy was a growing vertical with cheese and pizza, right, all the things that are in there, it gave us great support for what we have been able to see play out over the last 5 years. So what we thought we saw and the confidence we had to go do that has been borne out with the retention of a solid team, just a really good group of people that have melted well into the Nicolet life and culture. So that's been a boon for us. And we get that question, right? Your question is absolutely fair. We get that a lot. What the heck are you guys doing? You're a C&I bank. You're really good at that. What the heck are you doing in ag? And in essence, I'd say ag's a little bit C&I too, right? It's the same kind of thought process. Now, clearly, it's different inputs and asset classes, but yet it's an operator, an owner operator that's running a business that's there. And so again, that's worked well for us and with us.
But before we go over the Ken, I wanted to ask, you mentioned sort of the itch on M&A. You guys have been active, one of the more active acquirers out there. Lots of talk about potential rebound after a quiet couple of years. What does the market look like right now? I'm sure you get seeing lots of things. How busy is it? How busy are discussions? What's your view?
Yeah, so we get that because of the acquisitive history that you mentioned earlier. We get that question a lot. And I'd say with a bit of play on words, we're maintaining our discipline to be impatiently patient, or maybe we're patiently impatient, right? I don't know which one we are, but the discipline requires us to be impatiently patient or patiently impatient. So lots of conversations that are going on. We monitor our potential targets. That's there. But in today's world and the market that we have been in and that we currently are in now, with everybody thinking that this is about to pop now, we sort of think of it like an eighth grade dance, right? The boys are on one side on the wall and the girls are on the other side on the wall. And if you follow that analogy and it holds true, what we are is we're anxious for somebody to start playing some slow music so that we can figure out who really is interested in partnering up with a high-performing, successful integrator that sees the positive opportunities of movement into the future. And so that's really that's how we see it. And so right now it's just like, okay, somebody start playing the music so that we can determine interest beyond discussion that's there. Because again, we can do a lot of deals, we think, but are they the right deals for us to do? And if we can't buy banks, we have to wait until somebody says, I want to partner with Nicolet based on their success and track record.
And banks are sold, not bought. So you need them to start hearing the Stevie Wonder or the Al Green or whatever it is to get on the dance floor. Well, that's great. Well, let's transition to Ken. I want to start off kind of taking a step back and talking about your story as well. You know, when you think about Northeast, what do you think is the largest differentiator that you have as a community bank? And, you know, what has really driven your performance over the long term?
Well, obviously, most institutions will say that it's customer centric and individual service, things like that. I think that pretty much goes without saying. Our biggest differentiator, the two of them actually, is the urban submarkets where we lend and the physical locations of our offices. Our offices are all located in the hub of where we lend. For those of you, for those that don't understand or don't know where we are a heavy construction finance institution. We focus on the Bronx in New York City as probably the last affordable borough within the 5 boroughs. And we focus on Rockland, Orange, and Sullivan counties, which is northwest of New York City. In the Bronx, we finance the construction of rental apartment buildings that contain substantial number of affordable apartments. In Rockland, Orange, and Sullivan counties, we finance the construction of for-sale condominium projects within homogeneous communities. We also have offices in Massachusetts which focus on multifamily lending, permanent multifamily lending. I suppose what we are best known for internally is we focus on what we know and we don't stray from those areas of expertise. Unlike most community banks, I always get a chuckle when I say this, we haven't made a single family loan in 25 years for each matrix. And they cover things like location, loan type, loan duration. This is for construction lending. Loan to value, loan to cost, projected debt service if it's a rental, projected sales if it's condominiums. We look at the project sponsor's experience. We don't consider a sponsor or a builder to be very experienced until he's finished 8 projects with us, at least 8 projects. And we look at the guarantor's liquidity and FICO scores. FICO scores to us are not as important as the liquidity, because many of our borrowers that have literally $100 or $200 million worth of verifiable net worth have mediocre credit scores. It just happens that way. They've got a lot of debt, but it's offset by a lot of the loan to value ratios in their projects. After running the applications through a proprietary matrix, all loan applications, when they're ready, they're submitted to the executive committee at least 1 week in advance of any scheduled loan meetings. Loan meetings occur twice a month. Applications can only be approved, rejected, or modified by the bank's executive committee. The executive committee consists of our EVP, who oversees construction, our EVP and CFO, our president and CFO, and me. The members of the executive committee each have a minimum of 30 years experience. Loan officers, while they are excellent at what they do, honest as the day is long, they do not have the authority to approve loans. And that's because they work on salary and commission. And examiners just don't like to see a loan officer that's working on commission approving loans. We're examined by New York State and the FDIC. I'll be the first to admit they have a very, very difficult job. I wouldn't want to do it. It's not uncommon to have an exam team that has not had experience in the communities where we lend. We address the lack of familiarity at the start of an exam. We actually kidnap them. We insist that the members of the team that are going to be working on the lending portion of the exam pile into our corporate van, and we take them to the various communities. We give them the opportunity to actually see the projects firsthand. We let them walk the neighborhoods so that they don't get the feel that we're looking over the borrower and giving them hints on what to say. We show them thousands of units that we've financed. An examination team cannot accurately opine unless they actually see it and talk to people. We go one step further. Aside from the normal underwriting procedures and the matrices that we use, our executive committee, our lending officers, and our underwriting personnel, as well as our internal loan review personnel, use a software package that we borrow from the BSA department. We run the names of individual applicants, all the members of any LLCs, any borrowers, through a database that automatically runs every night and shows all information that might give pause to a loan approval. Drunk driving, convictions, it doesn't matter. We want to see everything about those borrowers. That occurs every night for existing borrowers. And as new loan applicants come through the system, it applies to them as applicable.
So I heard a wide variety of very good specific things, of very detailed underwriting to the project, very detailed underwriting to the borrower, against the borrower, also very detailed understanding of the given market you're in, and then lots of education to the regulatory investment community on why you are different there. I'd like to bring Phil back in and ask you and Ken the same question. Phil, the question is, what do you think is your biggest opportunity and really biggest challenge over the next 12 months?
Yep. So Nathan, I'm going to give you the same answer to both questions, right? So our biggest challenge, as well as our biggest opportunity at Nicolet, is cultural consistency, right? We believe we have really solid leadership. We're proud of the teams that we have throughout the bank, and we think we have sufficient runway. But our secret sauce is in the nearly 1,000 people that show up every day to do the best they can to live out our model of shared success that I mentioned earlier. And so, again, that cultural consistency of taking care of our stakeholders, our customers, our employees in the communities in which we serve, and our shareholders, it's really what drives us and what challenges us best. Again, a metaphor guy here. If you look at the shampoo bottle, what does it say? Lather, rinse, repeat. And I think Nicolet has 7 quarters of lather, rinse, repeat. And without providing a forward-looking statement as a public company, I would tell you that our focus is on lather, rinse, repeat as we go. And based on where we sit today, with this cultural consistency that we're working through, I really like our chances of success.
Execution, sticking to your knitting then. And can we do that? Ken, same question to you in closing. What do you see as your biggest opportunity and your biggest challenge over the next 12 months?
Start with the challenges. I suppose some of the standard answers would be the economy, interest rates, global unrest. Most of those just don't affect us because of the specific lending areas and the demand for housing within those submarkets. I've been doing this now for 50 years. I've seen countless economic cycles, and the submarkets where we lend just absolutely never let up. They just keep going. Opportunities are very, very, very simple. We stick to what we know and we don't stray from what we know. It's as simple as that.
Well, two similar answers from two high performers, figured out some strong niches, figured out some good ways to execute, and really just trying to continue to focus on doing that. But I think that's a great place for us to leave it and come to a close. Congratulations to both Phil and Ken on great years. Please continue up the great work. And thank you, Phil and Ken, for joining us today. And thank you, everybody, for tuning in. Really appreciate it.